Thank you very much and for attending our event. My name is Frank Milone. I'm one of the founding partners of FML, also a partner on the assurance and advisory practice. With me today is Bill Claffey, who's one of our partners on the tax services side. Thank you so much for the interest in the COVID-19 legislative update and review. There's a lot going on this topic, obviously, and we're going to try our best today to give an overview of what we've learned to date, and a lot of this has been changing even over the weekend. Just really quickly, FML is a full-service accounting firm headquartered in Glastonbury. We have over 80 people, 13 partners. We have offices in Enfield, New Haven, Stanford, and some other locations throughout the state. We also have a COVID-19 webpage dedicated to providing content and keeping our clients and our contacts up to date. So please visit our webpage at www.fmlcpas.com. There is a webpage there that's dedicated to the COVID-19 area. And with that, I will turn it over to Bill Claffey, my partner, and he will start us through the presentation.
Great. Thanks, Frank. So just a quick introduction. So I'm a partner. I'm on the tax side, as Frank noted. I do a lot of state and local work as well as tax incentives. I'm an attorney by trade. So I also get involved in our tax policy inquiries and tax controversy. And so as we put together this COVID-19 task force, Frank and I have taken the lead from both the tax side and an assurance side, and getting material up to our website, getting information out to our clients. There's a number of other folks in the task force as well. So I'm just going to give a real quick overview. And guys, I know a lot of folks know a lot of this information. You've heard of it. You've probably started to fill out an application. For those that don't, we're going to still provide the overview, but we're going to really try and kind of fast track the overview and get into some frequently asked questions that we certainly have been fielding over the last several days. And as Frank mentioned, as we get questions in, if we get the opportunity, we will respond to them in live timing. If not, we'll try and take a crack at it and distribute the answers to the group after this presentation. Just real quick, as this pandemic was hitting the U.S., the world and the U.S., the federal government's been very active. They've basically passed 3 major legislative pieces with a fourth, I think, coming down the pike real soon. The first was the Coronavirus Preparedness and Response Supplemental Appropriations Act. That was back in early March, and it expanded the current SBA economic injury disaster loan program to cover a lot of these COVID-related disasters, and we're going to get into that a little bit. Fast forward to March 14th, and you have the Families First Coronavirus Response Act, and that put the mandated sick leave and family medical leave provisions in place. And again, we're going to get into this in a little more detail coming up. The third phase of this federal legislative response was HR 748, the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act. A lot of us are obviously aware of this. This was passed March 27th, so a little over a week ago. And it provides a lot of things, but we highlighted, you've got the stimulus, which we'll talk about, the payroll Paycheck Protection Program, which is, I think, at most people's what most people are interested in. Small Business Debt Relief Program, we won't talk too much about that, but if you have questions, we can certainly try and answer them. The Emergency Economic Injury Grant, and then there's a lot of tax provisions that were provided in the CARES Act as well. So we'll just start with the EIDL program. That's the disaster loan. So that's a program that's been in place for a long time, and it expanded disaster areas, which are typically more like your FEMA-related hurricane, tornado type, flood type disasters. And it opened it up to areas that are affected by the COVID-19 pandemic. And that started with a few states, and now we're every state and local jurisdictions covered. Provides loans for small businesses up to $2 million. It's got a 30-year term loan maturity with the 3.75 interest rate for profit businesses, 2.75 for nonprofit businesses. There's applicants and awardees of the loan are allowed a 1-year deferral on payment back of the economic disaster loan, noting that interest will continue to accrue. Eligibility, I mentioned the 500 employee provision. That's a standard provision in most SBA loans. There are affiliation rules that Frank's going to talk in some more detail that apply to this program and also apply to the PPP program. One thing that the federal legislation expanded was the number of nonprofits that would be eligible for this program. The eligible uses, unlike the PPP program that we're going to talk about, the eligible uses for the disaster loan are much more expansive. So as you can see, working capital, repayment of debt, accounts payable, and other receipts in the normal course of business. They just don't want companies taking the loan to replace lost revenue. One of the biggest factors that came out with the EIDL program is that the federal legislation and the CARES Act allowed companies that were applying for the EIDL program, the disaster loan program, to get a more immediate, what they call the Emergency Economic Injury Grant of $10,000. So once an applicant applies for that program, you may have a 30-day window where that application is going to be analyzed and processed and reviewed. These grants of $10,000 are supposed to be getting into applicants' hands within 3 business days. Now, we've heard from some clients that are, I don't know if that 3-day requirement is being met. Sounds like there are some delays, but that's the intention of that grant. Miscellaneous provisions. So as with most SBA loans, we'll see the differences with the PPP program, but the EIDL program was updated to some degree pursuant to this federal legislation. The personal guarantee is only required for loans over $200,000. Collateral required for loans over 25. The SBA, will do an analysis of your ability to repay the loan. And just quick note that loan is through the SBA, not unlike the PPP program, which is being administered by all of our local banks. They do a credit check. They will waive the credit available elsewhere provision. That's pretty standard in all SBA products, but it was waived for this program through the federal legislation. They waive the tax return requirement, only requiring that you be in operation from January 31st, 2020. I think the old SBA programs had a 1-year in operation requirement. The interaction with the Paycheck Protection Program, you can apply for both. You can use the PPP loans to refinance an EIDL loan. They just require that the funds not be used for duplicative purposes, and so they look at that, at least in the guidance that I've seen, is that you can't take out a loan and pay the same person with the same funds. From the interpretation I've seen, you could use it to pay a different person or for a different period of time. You just can't duplicate the EIDL loan and the PPP funds for the same amount. With that, I'm going to pass over to Frank to talk about the affiliation rules, keeping in mind, folks, that these affiliation rules will apply for all SBA products, the disaster loan that I just discussed, and then the PPP program that came in as part of the CARES Act.
Thanks, Bill. So everybody who is applying for the Paycheck Protection Program, and as Bill mentioned, the EIDL, need to be aware that the SBA, who are really governing these programs, have certain rules requiring, obviously, businesses have to be under 500 employees, which has been very well publicized, as well as there's a test that also goes back to the NAICS codes for some businesses who may have a different employee count based upon SBA rules. But something that has gotten a lot more attention over this process is not just a hardline test on the employees, but also the affiliation concepts that are embedded in the SBA rules and regulations. And because these, like we've mentioned, because these programs are kind of attaching themselves to the 7A loans and the 7B2 loans, the affiliation rules need to be understood, and they actually can have a pretty large impact on companies that have venture capital or PE investment included in their capital table, as well as some nonprofits, from what we're getting an understanding on, also may have some affiliation rules to have to deal with. So under the SBA guidance, the SBA basically says business entities are considered affiliates of each other when one controls or has the power to control another, or when a third party has the ability to control or the power to control another. At the end of the day, the reason why this is important is if you're deemed an affiliate, when you're doing your employee count, you have to actually take your affiliate's employee count as well as your employee count. So if you're deemed an affiliate with another company and that company has over 500 employees and you only have 30 employees, you're ultimately going to be kicked out of being eligible for either the PPP program or the EIDL loan program. So this has caught a lot of people, especially like I've mentioned, a lot of people that have venture capital investment or have capital tables are more complex. But basically, the SBA has been pressured in putting out some affiliate rule guidance, which came out over the weekend. And basically, the guidance basically is trying to drive people to understand that there's going to be, especially for the PPP program, there's going to be four major tests that companies are going to have to go through the process of making sure they pass in order to not include another company into their affiliate guidance. The four tests are based on ownership. They have relationships to other related, I guess, debt or equity arrangements that you may have in your company and how they should be treated. They talk about affiliation based on management and then based on the intent of your company. So we'll walk through these really quickly. Affiliation based on ownership is pretty straight lined. If you have an entity owning or has the power to control more than 50% of the voting equity, it is deemed an affiliate, and as such, you need to include that company in your employee count. They talk about two other concepts that have gotten clarified over the weekend. One was if you don't have anybody who owns you over 50%, so you have nothing but minority holders, ownership of less than 50%, you will, in essence, deem the board, the president of or the CEO of the company, a managing member, or someone who controls the management to ultimately be the control owner of that company. But then they go through the process of if you have minority holders, and this is where this issue becomes very, very complex. If you have a minority shareholder that under your governance rules has the ability to prevent a quorum within your company or otherwise block actions by your board or your shareholders, you ultimately will need to evaluate whether that minority shareholder ultimately has control of your business and ultimately will be deemed an affiliate and therefore have to be included in your employee count. For a venture capital firm that has certain control rights over one of its investment companies, this becomes a huge issue because now the venture capital firm will be deemed an affiliate. And then as such, by the SBA guidance, any other companies that VC has invested in and has control over will also need to be included in your employee count. This is an area for most companies that is gaining a lot of traction, and most companies that we work with that are owned by venture capitalists or have venture capital ownership included in their cap table are clearly working with their attorneys to understand their minority shareholder rights to make sure that they pass this ownership test. So test number 2 is based upon rising out of stock options, convertible securities, agreements to merge. A lot of this guidance was to clarify how you should treat certain equity and other arrangements that have the right or the ability to be classified into stock at a future date. Basically, this guidance is saying you have to treat those instruments as if they've already been exercised when you're determining ownership percentages. And then they talk about some areas that do not need to be considered, talking about agreements that talk about future mergers, future sales. They talk about securities that maybe have an unenforceable or a very low probability of being exercised, not being considered. And they talk about future merger arrangements that are sometimes outlined in agreements and when to include those and when not to include those in your ownership percentage calcs. The third test is dealing with management, talking through different scenarios where whether the CEO of a company has the ability to control the management of another company, talks through the process where an individual or a company controls the board, and then also controls the board or management of another company, and the fact that those two situations would also deem those companies to have affiliate relationships, and then also talks about controlling another company through management agreements. And ultimately, if any of these three situations exist, you will deem to have an affiliate relationship with such company when you're going through the process of understanding your employee count and whether you qualify as a small business. The last test that they outline is affiliation based on an identity of interest, basically trying to deal with the fact that sometimes we have close relatives. They've clearly outlined a CFR section to define a close relative. And when you have an entity that is being run by a close relative with identical or substantially the similar business interest or economic interest, that once again, those two entities may be deemed affiliates in your process. There is some waiver rights and rules that are outlined in the guidance that came out over the weekend, talking about certain NAICS codes, talking about franchise businesses that are being recognized by the SBA, and then talking about companies receiving financial assistance through the SBIA Investment Act, and how that should be evaluated as you go through your affiliation rules. The last thing I'll state about this before Bill jumps into the PPP is a lot of the affiliation rules are complex. They've tried to give additional guidance. We've recommended to all of our companies that have complex cap tables or ownerships that have some minority owners involved, that they work with their legal teams to make sure that they're evaluating the affiliation rules before they apply for either the PPP or the EIDL. With that, I'll turn it back over to Bill to get into the PPP.
Great, thanks, Frank. So we'll do a quick summary, and then we have what we've seen as frequently asked questions at the tail end of this PPP piece, which you'll see when we get to that slide. There are some questions coming in on related to this PPP program, and so we'll address those either after this presentation, or I think some of these questions are already being addressed in our FAQ. So real quickly, as most of you know, this payroll protection program was added by the CARES Act. The intent was to keep people employed. It provides loans up to $10 million, and you're using your average monthly average of payroll costs. Now the act provides for the prior 12-month period. A lot of the applications are saying use 2019, and we'll talk about that a little bit later in the FAQ. You take that average and multiply it by 2.5, and that becomes your eligible loan amount. I noted here that there's an option to use January and February. This question came up pretty frequently during the tail end of last week for some of our newer businesses who may have been in operation at some point in that period, but not the entire February 15th through June 30, 2019 timeframe. And again, we addressed the FAQ, but our take is that we think that the intent is that you had to be in operation during that entire period for you to have to use the prior 12-month average. If you weren't, for example, if you started your business on June 5th, although you were in that time frame for a period of that date frame, that you would be able to use January and February of 2020 for purposes of your average monthly payroll cost calculation. So payroll cost includes salary, wage, commission, and other similar compensation. For those pass-through type entities, we're taking the approach that if you're paying your partners with a GP, that would go into kind of the other similar compensation and would be included there up to $100,000. Vacation, medical, sick leave, or allowance for dismissal and separation. One note on the paid sick leave and family medical leave, although you can include that in your monthly count to the extent that you're mandated by HR 201, which we're going to discuss, mandating paid sick leave and family medical leave, those costs are not eligible for your payroll costs. Group healthcare benefits, retirement benefits, and state and local taxes to employees. Those are the specifically enumerated items that are includable in the Paycheck Protection Program calculation of payroll costs that was enacted and signed into law on March 27th. There was guidance that came out from the SBA late Thursday night, right before these applications were due, which would potentially lead one to believe that there are potentially some other costs that are eligible, including certain employment taxes. Terms currently 2 years. Just note here, the CARES Act provided up to 10 years. Again, in the guidance, they said they thought the 2-year was the right time frame. The rate that I've seen on in the guidance and on the applications is 1%. Again, the CARES Act says up to 4%. At one point, we thought that might be a bank decision, but the SBA and Treasury has kind of stepped in and said we're going to go with 1%. And the loan forgiveness, which everybody's interested in, that's a point we're going to discuss later. The deferral, the act requires that all taxpayers can defer payment up to 6 months with the eligibility to move that deferral up to a year, just noting that interest continues to accrue. Eligibility. Again, you've got your 500 employees or less, taking into account all the affiliation rules that Frank just went through. Just noting that there are some NAICS codes, and there's actually a document you can get from, I think it's on the SBA website, that is an Excel spreadsheet. Find your NAICS code, and it will tell you what your employee count can be up to, or what your receipts. They do measure that on 2 different factors, and it looked to me from my first glance at the spreadsheet, they kind of do an either or. So if you're in, NAICS code whatever 7,000, they're going to give you a gross receipts measurement, or they're going to give you an employee measurement. The types of nonprofits that are eligible for the PPP loan is more restricted than the disaster loan we discussed earlier. So I've listed them out there. Sole proprietors and independent contractors, those are listed as eligible entities. We'll talk a little bit how that interplay is with companies that are using independent contractors, but they are listed as eligible entities, self-employed individuals. And as Frank mentioned before, for the food, hotel, and accommodations type businesses, they look at it on a per location basis, the 500 employee rule, versus aggregating all that. And then they waive the affiliation rules for franchises. So think, Subways and McDonald's and businesses like that. The act specifically lists out how you can use the proceeds of the PPP loan. So I've listed them out there. Your payroll costs, your healthcare, your interest on mortgage obligations, and your rent and utilities. There's dates when those either the rent or the utilities or the mortgage obligations have to be entered into by. But for most companies, they're going to have those. We're going to exist prior to February 15th. And then interest on debt obligations entered in prior to February 15th, 2020. So loan forgiveness, again, biggest topic. I think that certainly the most amount of questions we've taken. What's included? So you're going to look at your loan application from the date of origination. You're going to look at the next 8 weeks and what did you spend on those amounts for payroll costs, which we just discussed, interest on mortgage obligations, and rent and utilities. You're going to sum that up for your 8-week period, and that's going to be the amount that's eligible for forgiveness. The CARES Act provides that there will be a reduction to your loan forgiveness. There's 2 different components, right? So if you have a reduction in full-time employees during that time frame, or you have a reduction in salary to your employees of greater than 25% to those employees making under $100,000. Again, we're going to get into a question on the FTEs. The numerator and the denominator of that calculation is the average full-time employees during that 8-week period. That's the numerator, and the denominator is full-time employees from a fixed period in February 15th, 2019 to June 30th, 2019. How do I obtain loan forgiveness? It's an application. Once you go through that period, you're going to apply back through the same lender that you applied for the loan with. And then that's going to be either they have 60 days and they're either going to approve it, or they're going to deny it, or they're going to deny it partially or in full. Very important that loan forgiveness, unlike your typical loan forgiveness provisions in the Internal Revenue Code. Loan forgiveness per the PPP program is not included in taxable income. We've noted here just some of the miscellaneous provisions. The personal guarantee that's standard in SBA loan products is not a part of the PPP program. No collateral is required. The credit elsewhere provision is waived. Pretty much the only two requirements you're required to establish is that that you were in business and had payroll costs as of February 15, 2020. There's on the application, as I'm sure most of you have seen, there's a good faith certification. I believe there are six items, but the ones we listed here are regarding the need for the money to given these uncertain times to support ongoing operations, and that you're going to use the money for the costs we just discussed. The other bullet I've listed out here is that you can't take multiple PPP loans out for the same entity. We've gotten the question about consolidated groups. My understanding, and again, I assume there's going to be additional guidance that's going to come out, but based on the guidance that's out there, is that each applicant has a separate tax ID number and has separate payroll, and each applicant will file for each company with a separate ID would file for their own PPP loan. So you could have a consolidated group that's got four entities, with payroll. Four entities would apply for each for a PPP loan. However, when you look at their eligibility, you're going to have to look at the affiliation rules that Frank discussed earlier. Last bullet there, and again, I'm going to get into this a little bit more detail on the FAQs, but the CARES Act states that if you receive a PPP loan, you're not eligible for the worker retention credits, and if the loan is forgiven, you're not eligible for the payroll, the deferral of payroll taxes. So Frank, we're up to the FAQs. We can go through these kind of methodically here. If there's one that you want to jump in, we can kind of tag team this. And I'll just kind of start out eligibility. So this question came out a lot after the sample application was published by the Treasury Department, as there was a question on there saying if you have over if you had over a 20% owner that was a foreign individual or entity, you were ineligible. That was fixed, and I believe, Frank, you can confirm, but I think the new application does not have that question anywhere on it, and I can confirm that at least in part of the CARES guidance, it's not anywhere in the act.
That's right. Yeah, there used to be a question that was on the original application, and that's been taken off. Obviously, I think in the application, Bill, you still need to go through a process of listing out your 20% or more owners on the application. And then obviously, again, hitting on the affiliation concepts of minority holders, but having a foreign owner in and of itself is not going to kick you out of the PPP process. Hey, Bill, the next one that I would jump into, I think everyone's interested in what to include and what not to include on payroll costs. And I think you've done a lot of work here, so maybe you can jump in on some of those questions that people have on the payroll side.
Okay. All right, sure. I'll just start with the first question there. This question came up pretty frequently after the sample application and the application was published. And I believe the statement reads, most employers will use 2019 as the measurement period for calculating their average monthly payroll costs. The Act doesn't say that. The guidance doesn't say that. It clearly states that the prior 12 months. We've been talking with our clients. We've been talking with banks. I think the banks are telling a number of folks that they're okay taking the 2019 average monthly payroll costs. Again, this is inconsistent with the way the Act is drafted and the way the SBA guidance is issued. The guidance that came out on late Thursday night of last week, and there's even an inconsistency there with obviously the application instructions, and I think there was a fact sheet that came out earlier. What we're telling our clients is that we think you can use either. So talk to your bank. If it's advantageous for you to use the prior 12 months because you had a great 2019 and paid some bonuses in 2020, use that. If there's really kind of if it's 6 of one, half dozen of the other. And in gathering the 2019 data is just a lot easier and your bank's okay with it, then use that. And I don't think the banks are, rejecting any applications through use of the 2019 data. Just keeping in mind that we talked earlier about that, can you use January and February of 2020? That's limited to certain situations. Next bullet. This has gotten a lot of, we've had a lot of questions on this, the payroll cost. Do I include withholding or employment taxes, including the FICA federal and the state payroll taxes? So as you read the act the specifically excludes what the way they refer to it is Chapter 21, Chapter 22, or Chapter 24 taxes of the Internal Revenue Code. Those are specifically excluded. And so Chapter 21 is your FICA. Chapter 24 is your income, your basically your withholdings. So if you read that and you debated it, which we did, you would think, okay, well, I withheld. John Smith wanted, made an election to have X amount withheld. So I paid him $100,000, but he had $20,000 withheld. According to the act, I can't include that, which seems to go against every intent of the act, and certainly doesn't make any sense, right? If you're trying to get employers to maintain payroll and kind of get those costs back to them, then why would you not include withholding? Since the date of the act, right, the SBA guidance came out. And the guidance specifically provides that they list the enumerated costs, and then they exclude employer FICA taxes and other employment related taxes, which I would assume would be withholding for the period February 15th, 2020 through June 30th, 2020. And so we've talked about that and debated it, and here's kind of what we're coming out with. We think that the withholding was intended to be included. It was a kind of an oversight in the way the act was drafted, and that although you can take a position that the employer-funded FICA taxes could be included up to February 15th, 2020. We don't think that that's likely the intent of the law, and those FICA-related taxes are not specifically enumerated as includable. They're just kind of excluded from a certain date frame. So I'm sure lawyers can look at that a lot of different ways. Like I said, I'm a lawyer by trade, and I certainly have. But I think the most reasonable approach is to include the withholding in your payroll costs and exclude the FICA employer-funded piece within your payroll costs. Next bullet, can I include payments to independent contractors? Again, and Frank, you can comment on this as well, but this has been a source of very hot debate. Again, the way the act is drafted, I could make an argument that you certainly can. The way the guidance is drafted, it looks to isolate payments to independent contractors and sole proprietors and so forth, and provides that, hey, they can go get their own application. So thereby, you would think you could exclude that. However, there are portions of the guidance that provide that you should subtract independent contractor payments over $100,000. So they really kind of cut it both ways, and so I just in terms of a practical response, I would say this, and Frank, please correct me on this one if you think I'm off, but I think if you have independent contractors and they're immaterial, excuse me, and you're working with your bank, because I think most of the banks are saying exclude, then I would probably say for ease of administration, you wouldn't include them. But we have many clients who have, excuse me, hey Frank, take this for a second.
Yeah. I mean, I think at the end of the day, where Bill's going here is we also have a lot of clients that also have a significant piece of their what they would consider to be employee base that are working through a process of independent contractors, and are struggling with the concept of leaving them out of the payroll calc because of the significance in maintaining the viability of their business. And we're advising those clients to try to talk to their banks and get clarification. I believe a lot of what we've seen is interactions with banks to try to get clarification on the subcontractor and 1099 concepts. Unfortunately, there is no there is no definitive guidance right now. So I think in the beginning of the PPP process, it was a lot of indications were to include them. As guidance came out, most people interpreted it to say that the independent contractors should not be included because they have their own process of applying for PPP funding. But again, there is no guidance that I think we can give you that's other than our interpretation of what we're seeing. Bill, to change the subject a little bit, one of the questions coming up on the Q&A is, can you only include full-time employees, not part-time? From my understanding, part-time employees are included, right? Right, Bill? Yeah.
Part-time employees are absolutely included. They are excluded for purposes of the loan forgiveness calculation. So when, at least as of now, and again, I want to really stress to our audience here, the way the act is drafted, the guidance that's coming out, what I would expect to be the forthcoming guidance coming out, there are some inconsistencies there. And so, but the way the act is drafted and the way the guidance is provided to date is that when you do your loan forgiveness calculation, you're only looking at full-time employees, but for purposes of your payroll cost, average monthly payroll cost calculation, you're looking at compensation to part-timers and full-timers.
Yeah, and one of the last points, and then we'll move through some of this, is there's a question on what do I do if I reach out? Where do I reach out if my bank won't accept my application? There's been a lot of back and forth, especially Friday, Saturday, on certain banks not allowing a certain quote unquote level of customer to apply for the PPP loan through their banking institution. I believe a lot of those institutions got pushed back from clients as well as the government reaching out and trying to clarify that they do not want banks to restrict their current client base from applying in at any level. Obviously, I think banks are taking an approach where if you're not a customer of the bank, unless they're able to handle the volume, they're not allowing non-customers to apply in. So unfortunately, at this point, I know that some of the banks that I've heard that are maybe originally restricting certain access to their clients have changed. And so if you've gotten an answer before the weekend was over that the bank wouldn't allow you to apply, I would strongly suggest that you reach back out to your bank and ask the question again, because most of those banks have been pressured into allowing all of their customers to apply for the PPP process. Bill, we have more Q&A here. You want to continue to answer these?
Yeah, sure. So timing, obviously a lot of folks are, when can I expect the funds? Everything we're hearing and the intent of the law is to get these funds out to applicants, approved applicants within 30 days. Time will tell, right? We're in, business day number 2 of the applications. I do know that the portals that banks are setting up have been inundated with applications. It doesn't take a math wizard to kind of take a look at $349 billion and the number of small businesses across our nation and figure there's going to be a real tap on those resources. But the guidance does say that it's a first come, first serve program. However, again, you could see something come out from the Treasury and, as little time as today, saying that they're going to do some sort of prorated or they're going to do have some additional funding designated for this program. But 30 days is what they're saying. So this question came up, and I'm just going to give a quick answer. Can we get a loan for less than 2.5 times payroll cost? There's certain reasons why folks may not want the full loan, but my advice would be there's no prepayment penalty. Figure out your monthly cost, multiply by 2.5%, and take the maximum. There's nothing in the loan application that says you can. I don't think there's a spot where you can claim less. That maybe that's something you could negotiate with your banker if you wanted to. But once you got approved and you didn't want the funds, I would just make a prepayment back to the bank, and then you can keep what you need. Loan forgiveness. This question has come up quite frequently with regard to terminating employees, now or at some later point. So there is, when you look at that loan forgiveness calculation, we talked about the reduction based on headcount. The Act specifically provides that if you bring those employees back, not those employees, whether if you bring back that full-time employee headcount back by June 30th, then your loan forgiveness due to reduction in employee headcount won't be computed. One very important provision there, and it's in the Act and in the guidance I've seen, is that termination or that furlough has to occur by April 26th, right? So if you get into a situation where you decide to furlough employees on April 28th, then you're outside of the scope of the reduction exception for bringing back employees to June 30th. And I know we're kind of going in a lot of different kind of zigzags there, but that's the way the code reads, and that's the way I've seen the guidance. Now, again, could something come out in the week saying, well, we're going to extend that period to, to June 30th, maybe, but just be aware of that, that if you're going to make the decision, you got to make it in 3 weeks. Loan forgiveness. So 25% rule, I think it may be somewhere on the application. It was in the guidance. The original Act, it provided nothing about 25%, but the guidance basically says that, kind of in consultation with the Treasury, they're only going to so if you look at your loan forgiveness calculations, let's say it's 100, only 25% of that 100 can be related to non-payroll costs, right? So your rent, utilities, and mortgage interest. To the extent you had 40% of your loan forgiveness calculation as relating to those costs, they're only going to forgive the first 25%.
Hey, Bill.
Yeah.
We're going to jump through. Let's keep going. And then if we have more time at the end, I want to make sure we have enough time to get through the rest of the slide deck. Yep. And we'll come back to frequently asked questions if we have time at the end. Does that sound good?
That sounds good. Hey, can I just answer one question quick here? I know we only have 2 left, but let me just, because it got asked a few times, the tax credits. The Act provides that if you're getting the payroll retention credit or the payroll tax deferral, how do you handle that? The Act provides that if you're getting the PPP loan, then you're not eligible for the employer retention credit, and that if you're looking to defer taxes, you can't take advantage of the payroll tax deferral if your PPP loan is forgiven. And just quickly, and we can kind of come back to this, but that's a timing issue. The way that I read it is that let's look at the deferral. You got kind of 3 situations there. You got the kind of situation A would be once your loan is forgiven, you can't defer taxes from that point forward. That's kind of best case scenario, right? So we're looking at some point in August. Kind of the middle case would be you can defer your taxes. Once the loan's forgiven, they're going to have a catch-up payment on that, and you're going to have to pay the deferred taxes on that date, and then pay your payroll taxes going forward. And then situation C, kind of worst case scenario, is that once you have a loan forgiven for any amount, you were never eligible for the payroll tax deferral, and you're going to have to pay the taxes and penalty and interest from the dates they were due until that date of forgiveness. We think it's situation B, kind of the middle case there. But again, there could be, I would expect guidance from the IRS on that front. Okay, Frank, sorry, let's keep moving.
Okay, so the next area that we're going to briefly touch on, and I mentioned briefly because it will be very quick, is the paid sick leave and the paid FMLA under HR 6201. The first thing we'll say is we've gotten a lot of Q&A on this early on because this came out before the PPP was finalized. And one of the things that we've strongly recommended is if you have questions in regards to the Family First Coronavirus Response Act and how it impacts your individual employee base, how you need to manage the sick time and the FMLA concepts, please talk to your employment attorneys. They're very much up to speed on this aspect. There are some tax credits that come along with this that we'll touch upon as well. But as many of you know, the paid sick leave under HR 6201 requires employers to provide employees with paid sick, There are 6 reasons why they should be able to take that paid sick leave of 80 hours. The process, just to make sure the 80 hours that gets applied here will be in addition to any paid sick time that you have within your employment process currently under your current policies. And it does apply to all companies, not just, so if you have a company that's under 50 employees, there's been a lot of questions as to whether you can get exempted from applying or applying the 80 hours of additional sick time. There is a process where smaller businesses with fewer than 50 employees may qualify for exemption from the requirement. But at the end of the day, I believe you need to apply for that exemption. You can't automatically take it on your own. So as you go through this process, make sure that you're working with your employment attorneys to understand that. There are a variety of what needs to be paid for employees that are taking sick time. As you can see in this slide, it all depends on what reason they're using, how much they need to be paid, whether it's regular rates, whether it's 2/3 regular rates, and there's always a cap that's been outlined by the Act. Please make sure you read this in detail and also understand that it covers all employees regardless of, their tenure within the business. The paid family medical leave provides that covered employers provide, again, family medical leave to their employees that are unable to work as it relates to the fact that they need to care for a child whose school or place of care has been closed. Ultimately, under FMLA, they get 12 weeks. The first 2 weeks for this reason would be unpaid. They can take their vacation time. They can take any of their paid time off. And then at that point, they would get 10 weeks at 2/3 their regular rate, again, capped at a certain point. And again, specific rules for who gets covered under this aspect of the HR 6201 are employees employed for at least 30 days prior to the process happening. So there are different credits relating to the application of this and getting reimbursed. Bill, do you want to take this one for me?
Sure. Yeah. So because this is a mandated, payment requirement for employers, they provide that the employers can get reimbursed for these paid sick leave or paid family and medical leave payments through tax credits against their employer-funded FICA taxes. So as you're looking at that, you would offset your deposits, and it's not a one-to-one correlation, right? So you don't get, it's not I had to pay sick leave to employee A and I paid $1,000. I can only use that $1,000 against employee A's employer-funded employment taxes. You can take those credits against your total employer-funded taxes. And so if you have excess credits, those credits will be refunded. There's some limitations if you're taking WOTC credits, or if you're taking, we have a number of clients of ours that have taken the R&D credit against employer taxes. So there's limitations on the use of this if you're taking those.
Hey, Bill, sorry to interrupt there, Bill. I think when it comes down to some of these complexities, the recommendation we're giving to our clients is, obviously work with their accountants, right? And work with us to work through the credit process and work through the understanding of how to take it, when to take it, and how much should be applied based on some of the other technical concepts that you're going through, correct?
Absolutely. Reach out and the fourth bullet, can you just go back there for a second, Frank?
Sorry.
Yeah, sorry. The fourth bullet there. So unlike the loan forgiveness, the Treasury and with the IRS guidance has concluded that those credits are included in taxable income, right? So you're not getting although you may be paying $1,000 and then getting a credit and applying that to your taxes and then getting a refund of any overage, that's a taxable income to you. So you're not getting kind of a one-for-one. You're not being made whole one-for-one. And then in practice, so there's a Form 7200. And so, but what I think most companies are doing is they're reducing their deposits by the anticipated credit, and then filing this Form 7200 to get the refunds. Okay, moving over to tax considerations, and I know we're running out of time, so I'm going to try and get through this as quickly as possible. As this CARES Act and the other legislation kind of came down the pike, the first thing that we heard from the government with regard to taxes was the extension of deadlines. So you see, we've got the federal filing deadlines and payment deadlines, and Q1 estimates extended to July 15th. From a state perspective, we cover Connecticut in a little bit more detail here, but they kind of have a wide range of what they've extended, right? They've got the individuals extended to 7/15. They've got the Q1 and Q2 payments for individuals extended to 7/15. But with regard to the corporate taxes and the PET taxes, they've got different dates that are out there. So just be aware, our website has basically a 50-state rundown, with Connecticut going into a lot more detail. Many states have extended sales and use tax returns. And so, again, while we have Connecticut in a lot of detail on those sales and use taxes, if you need assistance because you're filing a sales tax return in New York or any other jurisdiction, just reach out to your accountant and ask those questions, because they may be very different by state. The employer retention payroll credit, that was the one we discussed earlier in the FAQ. That gives you the employer a credit for 50% of the first $10,000 they have to pay to an employee because of one, a government mandated closure or isolation of a facility, or two, a 50% reduction in receipts to the business in the current quarter compared to a comparable quarter in the prior year. Again, you're going to have this interplay between this and the PPP loan, and it's a timing concept. When we respond with our FAQ response, I'll try to get into a little bit more detail on that. Payroll tax deferral, we talked about that, right? There's no specific restrictions. Taxpayers right now are allowed to defer their employer-funded payroll taxes. That the deferred taxes 50% of them become due on December 31st, 2021, and 50% of them become due on December 31st, 2022, and that applies to taxes through December 31st of 2020. The NOL loss modifications. So again, all these concepts were put in place to get cash into businesses' hands. So that, for lack of a better term, fixed kind of the Tax Cut and Jobs Act NOL limitation, which was limited to 80% of your income, and that act in 2017 also restricted the carryback allowance for NOLs. This CARES Act basically says you can carry back losses for the prior 5 years if they were incurred in 2018, 2019, or 2020, which is the periods after the Tax Cut and Jobs Act. So you basically can go back and amend a return in 2013 if you had NOLs that could be carried back. And obviously, we're expecting a lot of companies to have NOLs in 2020. AMT, same concept. The Tax Cut and Jobs Act did away with the alternative minimum tax for corporations, but companies had AMT tax credits that they wanted to utilize. This allows you to use those credits. There was a phase-in period. This allows you to use them in 2019 or 2018 to get excess cash. The business interest expense limitations. This was a limitation that was put in place by the Tax Cut and Jobs Act. It allows increases the interest limitation from 30% of AGI to 50% of AGI, and also allows companies in 2020 to use 2019 as their measurement year. Again, as you can expect, there's going to be a lot of companies with losses, and they didn't want to have that restriction on the business interest expense deduction being calculated off of fundamentally zero. And then qualified improvement property. Again, this fixed the other provisions really just modified or changed provisions within the Tax Cut and Jobs Act. The qualified improvement property provision in the CARES Act really fixed what was always known as a glitch in the 2017 Tax Cut and Jobs Act. And what had happened is that the 2017 legislation basically took qualified improvement property and gave it a 39-year designation, even though that was never the intent. and thereby making it not eligible for bonus depreciation. While that was always intended to be fixed, it never was. And so the CARES Act basically fixes that and allows you to take the immediate depreciation through bonus depreciation. Individual taxes, you've got the stimulus package, which is obviously in the news a lot. Just know that $1,200 for single individuals and $2,400 for married individuals plus $500 per child gets phased out, as most of us have heard, by 5% over the overage. And the way that's going to play out is you're going to get if someone's eligible, they're going to get an advance, soon if they haven't received it, and that will you'll get a 2020 income tax credit for the amount that you're eligible for, and the advance will kind of go against that. So you could have a situation there where you've got someone who was not eligible for the advance in 2020 because their 2019 income was too high, but then they got laid off or didn't have income in 2020. They're still going to get that money. They're just going to have to wait until the 2020 credit. Retirement plan. So the CARES Act allows you to take a distribution up to $100,000 for it's called a corona-related distribution. If you're an individual diagnosed with COVID-19, you've got a spouse or dependent diagnosed with COVID-19, or you're experiencing adverse financial consequences as a result of being quarantined, laid off, or having reduced hours. Withdrawal of up to $100,000, that's gonna be taxed. Any income, income on the withdrawal is gonna be taxed over a 3-year period, but they allow you to recontribute those amounts within a 3-year period without any kind of cap. So the existing caps on those contributions that exist would go away for a recontribution. Charitable deductions. Actually, there's a business and an individual component to this. For individuals, if you don't itemize, you can get a $300 charitable contribution. If you itemize, individuals can have an unlimited charitable contribution, and corporations, the limit cap is increased from 10 to 25%. And then the last piece on student loans. So it allows an employee to exclude up to $5,250 from income education loans paid off by their employer, and they have to be direct by the employer, direct to the employee. So employee can't pay off their kids' student loans. It has to be kind of a one-to-one between employee and employer. So again, we whipped through those pretty quickly. Hopefully we covered some of the kind of the crisscross between the tax considerations and the various SBA loan provisions. And like I said, we'll go through these questions, and to the extent we can answer them, we will. And Frank, I guess that's all that I have. I know we were about a minute left here.
Yeah, there's a lot of questions. Obviously our contact information is up there. A lot of people looking to hopefully get their questions answered. I know there's a lot of specifics. Bill, there's a question that says, what does a business do with employees already laid off because there's no work for them? Do they get paid to stay home? And I would assume that means if they're getting PPP funding, I guess at the end of the day, in my opinion, Bill, if they're still laid off, they wouldn't be getting paid through the PPP process, right? Because they're not on payroll. But if that employee got hired back for a 2-month period and was getting paid through the PPP funding, I'm not sure they would be getting paid to stay home. Obviously, you're hoping to keep those employees busy, but the concept of the PPP funding is to keep people employed. So do you agree with that response?
Yeah, that is clearly the intent of the PPP program is to keep people employed and keep people out of the unemployment line. However, I mean, that question has come up quite frequently about, well, what if can I keep people on my payroll, but there's no work for them to do? The PPP would allow that. Clearly, you're not reducing your FTE count to the extent that you already furloughed or terminated employee. To your point, Frank, you're not going to be paying them, and so that loan forgiveness amount is only for what you're paying in the next 8 weeks, and then you got to go through that calculator. So when you go through that calculation, they're going to look at the numerator being your FTEs from February. I know there's some questions on seasonal employees, but I'm just going to, we'll answer those specifically to those questions. But for most companies, your numerator is going to be your FTE count for the 8-week period following the loan origination, and your denominator is going to be the FTE count from February 15th to June 30th of 2019. So you got to bring those employees back in order for that reduction to not count against you.
So I think, when it comes down to it, if you're going to apply, you're going to get the funding and you're not going to hire employees back, you're going to be required to pay all that money back. So
yeah, you're going to get dinged under the loan forgiveness reduction piece. That's of right. The program.
So Another question, Bill, was if we did the PPP and the EIDL, which do you use first for paying employees? Can you do PPP for the first 8 weeks and then use the EIDL? I think you absolutely can. I think you've got to document the fact that you're covering a period that's outside of the use of the PPP funding. And if you can document that accordingly and use the EIDL loan provision or proceeds to fund employees over a longer period of time, I believe that would be an appropriate segregation of the funding and what they're being used for. Correct, Bill?
Yeah, absolutely. And just more emphasis on that. I mean, when you go through your loan forgiveness calculation, the banks, the lenders, when they're reviewing it and auditing it, they're going to be looking for a very specific, trail map for the PPP loan proceeds. So I would do exactly what you just said, Frank. I would use all my PPP loan proceeds, pay your employees that way, and I wouldn't even commingle any of the disaster loan funds for that purpose until your PPP loan is fully exhausted.
Yeah, we got a lot of attendees that are still on. I can see people, obviously, we're going to continue to answer some questions, and if we'll also do them, email them out. But if you're still on, we'll continue to email or answer some questions here. Bill, in relation to that, there's a question on documentation. On how exactly the act and some of the legal aspects of documentation are going to be applied into the process. I don't think there's a good answer there other than to say if you have expenses that you're paying with PPP proceeds, you obviously want to track those pretty rigidly with your accountant and with your internal and external accounting function, and make sure that you're tracking the use of those proceeds. We've talked about not commingling funds, if able to segregate that funding into a different bank account. But at a minimum, you're going to have to keep very detailed records as to how you're spending that cash to make sure that you're not going to have to scramble to assemble how you're spending that money to ensure forgiveness under the program. Anything to add there, Bill?
No, I think that covers it all. I know that there's, and I'll try and get this in the written response. I know the guidance provides some suggestions on documentation, and there's probably some other guidance on your typical SBA product, which have been around for a long time. But the banks are also providing guidance on that, and your specific bank may provide guidance on that. So I would, like I said, we'll try and answer it as best we can. But I think you want to really have a good conversation with your bank, especially once you're approved, and just ask them exactly what documents they're going to require.
Yeah, I mean, another question is, which program is preferable, EIDL or PPP? It really depends on the company and what they need funding for. The PPP program is less cumbersome from a standpoint of documentation requirements during the loan application process. It has much more flexibility in forgiveness. There is no forgiveness provisions under EIDL. You have to prove your ability and intent to repay EIDL. So that process is a little bit more cumbersome for companies. Credit rating comes into effect. Potentially personal financial statements come into effect on the EIDL. So obviously the PPP program is definitely the more preferred program for small businesses just looking to fund the gap in income to help keep their employees engaged. Bill, another question coming up on employees. If you've already furloughed some FTEs prior to March 30th, do you have to bring them back during the 8-week time frame? I believe the answer to that is yes. If you want to have them qualify for forgiveness, because you're going to get those employee payroll and FTE counts funded through the PPP program. You don't have to bring them back, but just be understanding that it may impact your ability to get that loan forgiven. And as a result, you just have to make sure you have the ability to repay any amounts that aren't forgiven under the loan. Bill, agreed?
Yeah, I completely agree. There's two pieces there, right? If you're not paying them, then those proceeds are not going to go into your loan forgiveness calculation. And I get it. It's a little bit the way that the program lays out is, probably doesn't make sense for a lot of us that are in business and trying to, might not think that's the American way, but that's the way the program was laid out. But more importantly, when you look at the way the loan is forgiven, again, they're going to apply a calculation that's got a numerator and a denominator. So when your numerator is down because you have employees that are furloughed, your percentage is going to be less. So yeah. It's like I said, it may be counterintuitive to some, but the way that the thing plays out right now, you want to have that numerator as big as you can compared to your denominator, which was that February to June, March measurement period in 2019.
I think some of this comes down to the type of business you're into. I know someone with some restaurant, maybe their business was a restaurant. They have no ability to open. They have no ability to maintain employees. At this point, does it make sense for them to put under the PPP program? Obviously, it really depends on those circumstances, because now a restaurant can only do maybe takeout and have a lower employee base. They may ultimately take a loan that they need to repay, but if it allows certain aspects of their employee base to stay employed, they have to weigh the benefits of that. Bill, specific question on HR 6201 tax credits. Is there a specific form that needs to be applied to get that credit? Or do we have any indication on how that gets applied for?
Yeah, I believe, and I'll pull up the form just to confirm and shoot it back through our kind of email response, but I believe those credits are coming through that form 7200.
Okay.
So I know there's I think that's the form that you would use. And like I said,
go ahead. I'm sorry.
Yeah, I mean, if I were a business, the way that I would handle it is I would talk to my payroll provider, and I would start telling them to, if you're going to be mandated to make those payments, those credits are going to be some pretty real money. And I would inform my payroll provider that you're going to be taking these credits, and they should be taking those. They should be offsetting those against your deposits that would otherwise be due, so that you're getting that money back in real time.
Yep.
And then use form 7200 to apply the overage.
Yep. Question on nonprofits, Bill. Neither you or I are experts on nonprofits, but do we know if there's an extension for filing the 990 for nonprofits, or do we need to get back to that person after talking to our nonprofit expert?
Yeah, I'll save that to talk to our nonprofit folks.
Okay. Another question, Bill. If you're an essential employer, can additional hazard pay bonuses be paid during the 8 weeks subsequent to getting the PPP loan and be counted for loan forgiveness amounts?
I don't know of any restrictions on the compensation you can pay during the 8-week period. So, for example, and it's a good question, and I got to give it a little bit more thought here, but there's all the restrictions on the up to $120,000 on the calculation of payroll costs. I don't know, and again, I'll try and answer this, but I don't know if in the kind of the loan forgiveness payment terms, whether they put that same restriction, unless you bring it back to payroll, unless you bring it back to your definition of payroll costs.
Yeah, I think this one may have a little depth to it, Bill. I think we're going to have to think this one through and maybe give a response email wise.
It's a great question, though.
It is a great question. Absolutely agreeing. How long does the loan approval take? Anybody's guess at this point. And like Bill said, for the PPP, I think the banks are trying to turn it around in 7 days. My guess is that's not going to happen right away. Understanding that they're trying to get the cash into the business's hands as quickly as possible, but the process has gotten off to a slow start because of the urgency in getting the portals up. I think you got to give your bank a little bit of time, obviously keep on top of them, but the approval process and getting the cash into the business's hands is going to take a little bit more time in the beginning, I believe. Hey, Bill, I think we've done a good job here. We're about 10 to 15 minutes over. We still have 50 people on. So I'm going to throw a couple more questions out. Does the 8-week time frame begin at loan approval date, or can we set the date as long as it begins before June 30th? I believe it's when the loan approval date happens, Bill. Is that correct?
Yeah, per the code, it's based on the date of loan origination. As we're sitting here, I'm just trying to check that, but that's my understanding.
Yep. In the total number of employees on the PPP app, how is that calculated if you have FTEs and PTEs? And I assume PTEs are part-time employees. Is there a specific, and again, Bill, this may be too detailed, but is there a specific adjustment when you're looking at part-time versus full-time? I think it's just each one will count as an employee, and those measurements will be recalculated same way to calculate loan forgiveness, correct?
Yeah, I mean the way it's drafted up, you're looking at full-time employees only. I would imagine the SBA may come out, or the Treasury Department may come out with some regulations that put in some provisions for for full-time equivalents, whereby you might take two part-timers and that becomes one full-time employee, but that's not out there yet.
Yep. Should we include health and dental figures in payroll costs? I believe you do add them into payroll, Bill, if I'm not mistaken here. Even if you have an employee that's making over 100 grand, the salary would be capped at 100, and then you would add in the health and the dental figures, even to those people who are capped at $100,000. Correct, Bill?
Yeah, that's the way we're reading it. I think that's pretty consistent with most everything I've seen out there. So yeah, it's a compensation capped at 100 plus health plus all the other things that we noted earlier.
Are there restrictions on payments to owners related to forgiveness? I don't believe so. I believe owners are treated up to that $100,000. I don't believe if you reduce people's salaries making over $100,000 after you get the PPP, that won't go into loan forgiveness, because the calculation only includes payroll costs up to $100,000. But I would believe that if you are, and again, this may go to the bonus concepts, if you are laying off employees and paying owners, you're obviously going to have a negative on the forgiveness, because your employee base will go down. You need to maintain both employee levels and compensation levels for those employees up to $100,000. If you do reduce any of those and continue to pay owners, you will get forgiveness reduced. I'm not sure if there's anything else you want to add there, Bill.
No, I think that covers it. Yeah, that the reduction in salary only applies to employees making $100,000 or less. So if you had an employee that was making 200 and reduced them by 80,000, it doesn't look like the reduction in salary provision would kick in for that person.
Yep. For benefit figures for the PPP application, do you include amounts employer pays or just employees? So question on employer versus employee contributions into the benefit side.
Yeah.
I think we were debating this last night, Bill, weren't we?
Yeah, and kind of the same kind of argument could be made for the for the tax piece. I think we were looking at it as the employer portions of those expenses, because that's who you're trying to make whole here during this process.
Okay. And I'm going to add one more, and then I think we're going to go. The last question, I think someone is not, we're not answering it the right way, so they've asked it again. If we are shut down now, cannot bring employees back until that is lifted, I assume because they're a non-essential. do we wait to apply for the PPP then? So I guess the point being, Bill, is if they apply and they can't open up again because of the restrictions on non-essential businesses, they're at risk of not being able to hire their employees back. So should they wait on applying for the PPP? I would think that's a great question, right? Because if you can't hire people back because your business cannot operate under the current state mandate, do you need to wait? I would think that's probably, if you can't open up and rehire employees, you probably want to wait, or you can apply now and understand that you just have to take those proceeds and repay the loan, and then take on the 1% interest charge.
Yeah, I mean, you've got like a 30-day window here, and maybe longer from time of application to when you might be approved. My suggestion would be apply. The worst thing that could happen is, you'll have more information in 30 days when you get approved, and then you can always, make that payment back to the loan back to the bank with literally nothing lost.
And they asked about a deadline, Bill. I think the deadline's June 30th, but we're just not sure the funding's going to maintain itself all the way through, right?
Yeah, the loan program is by statute extended to June 30th, 2020. But I mean, all indications, everything that we've seen, heard, read, is that we're not going to even get close to that date before these funds are exhausted.
Okay. Well, listen, this has been great, Bill. Appreciate the extra time. I think we went about almost 20 minutes over here, 15 minutes over. This has been great. Again, we have our contact information up there. We're going to do our best to answer all of your questions in writing and send it out to the 70 or 80 people that actually joined us today. We still have 46 members listening in, so I appreciate your willingness to stay on with us. Hopefully, we've added some value. Don't be afraid to reach out to us via email or give us a call, and continue to look at our website and look at our page dedicated to the COVID-19 responses from both a knowledge base and interpretation base of the rules and regulations. Thanks again, everyone. Have a great rest of your day, and stay safe, stay healthy. Talk to you soon.